This is Money Management.
Managing Director at Medallion Financial Group. For you, Michael, you know, we've had a few bumps along the way in the past couple of days. Is it anything, a bit of a harbinger of things to come?
Look, I think it's much the same. There's a lot of people still on holidays. Volumes are still very low. But we are optimistic. Obviously, you've heard it all before. Synchronised global growth. The earnings revisions are moving high from a lot of the investment banks and the companies themselves. So I think we can be cautiously optimistic. But asset values are quite high.
Yep.
There are certain sectors of the market that are more expensive than others, so you do need to be on your toes, because I don't necessarily think it's going to be all sectors moving high in unison.
Tonight we are working with viewer Jim's portfolio. Now Jim writes to us, I'm 57, I'm looking to retire in about 5 years. My SMSF portfolio is $872,000. The portfolio has done well in the last year, good on you Jim, with mainly Aussie shares and 19% of the money in cash. I've avoided banks and materials and had only a few disasters. I'm wondering what I should do now with the cash I've got in the fund. All right, let's get a quick look at Jim's portfolio. Now, when we look at Jim's portfolio at a high level, not only do we have a complete Aussie equities array within there, we also have a very large amount of cash, as you mentioned, 19% of 872,000. Well, that's actually a chunk of money. Now, while the portfolio has grown roughly 19% in the last 12 months, and that's a pretty good outperformance against the ASX 200 and 300. In fact, it's a pretty good performance. Could have been a little bit better had he avoided some of those disasters he mentions in there. Isentia, Certex, Regis Health, Telstra and Vocus being those disasters. And look, let's face it, many people have had those in their portfolios in different measures, but also massively outweighed by some of the winners this year. A2 Milk, let's face it, that's done very, very well. Blackmores has been good for him, Aristocrat and also Domino Pizza. The key thing with the portfolio, and for Jim when we talked to him a little bit earlier, is the fact that he's very much focused on growth. He's not really a risk-averse type of an investor, and while he's 57 and looking towards retirement, he's really looking for a solution to utilise the cash in the portfolio. So let's have a quick look now, just thinking about how the portfolio is structured. We'll just quickly look at his sector allocation. Asset allocation, of course, just refers to cash versus shares. That's about 80-20. But in a sector allocation sense, he is heavily underweight financials and materials and very heavily overweight consumer discretionary and healthcare. So some of those bigger names in there, for example, the likes of Domino's Pizza, for example, Blackmores, Regis Healthcare, one of his disasters in there, have been his big overweights. And financials-wise, well, it's really just a CBA. He's dramatically underweight the index, but as far as Jim's concerned, the index doesn't really matter to him. Do you think, Michael, the cash level in that portfolio, is it an opportunity or is it a bit of a drag on? How would you position the portfolio?
I'm inclined to hold cash at all stages, because it does give you that flexibility, that optionality to deploy should an opportunity present ourselves. And given the time of year, sort of early January, we are about to head into the half-yearly reporting season in February. Often you get companies that are unfairly penalised if they slightly miss expectations or if the market's expectations were too great. So I think having some cash up your sleeve makes sense. Whether you want to have 20% of cash is probably a little bit excessive given the momentum that we have in markets, but somewhere between 10 and 15% I think is reasonable.
Diversification, you know, it's a reasonably diversified portfolio, you know, sectors and so forth wise, but also in terms of names. There's some good breadth in there, so not too much concentration, but a very heavy overweight in a couple of key sectors, the discretionaries and also in healthcare.
Yep.
Michael, just for yours, how big a portfolio should you have? You know, should it be 10 stocks, 20 stocks? You have a rule of thumb you operate at.
A lot of research done. It's quite ambiguous as to the exact number. I think it just depends on the individual. Some people can ride the volatility and they have utter conviction in the companies that they're holding. We typically have for clients between sort of 15 and 25 companies. I think if you start to hold too many businesses, you just by default have too much diversification, you just start to mirror what the index does. So you do want to have conviction in what you do, but the ultimate number really depends on the individual.
Yep. Let's go into asset allocation, but more importantly, sector allocation now. Now, I want to talk through this particular slide. It is a very busy slide, but the key thing here is to have a think about where the money is being directed. Now, there are a number of subsectors on the ASX 300. They're listed down the left in blue, and in the middle is the patch which indicates between myself, Michael and Mark, where we sort of sit with certain sectors, And as you can see on the right, we aggregate those into one consensus view, as we call it, for sector allocation for Jim's portfolio. Now, there's really a clear theme that's coming through here, guys, just in terms of where we sit with certain sectors. There's a little bit of, jostling there with materials, for instance. And I might just come to you first of all on this one, actually, Michael. For materials, I'm still someone who's a little bit keen on the commodity cycle. I can't help myself in that particular sector. But in aggregate, between the three of us, we're absolutely an underweight. For yours, materials remains a bit of an underweight?
Look, for me, materials, it's very difficult to predict the cycle. They are very cyclical. Obviously, they're price takers, and it's very difficult to predict what the iron ore price is going to be in 2 years' time or 5 years' time, let alone 10 years' time, and things like that. So you can't really extrapolate the earnings out into the future. If you look back to 1980, for instance, the resources index has actually underperformed the broader index excluding resources, and that's despite the big commodity super cycle that we went through going back a couple of years. So when you consider the returns relative to the risk, I think I'm always going to be underweight. At the moment, however, I do see some reasons of holding things like BHP, for instance. We've got the synchronised global growth, as I sort of touched upon earlier, and you've got a lot of people coming into those cyclical sectors because commodities, whether they're agriculture commodities, bulk commodities, are all doing well at once. And that's just, I think, a symptom of the fact that we've got all continents of the world moving forward at once. So that's why I'm happy to have some BHP in my portfolio, for instance. I'm happy to have some energy companies, but broadly speaking, I'll normally go in with an underweight position most of the time.
What about for you, Michael? Is it an theme based on interest rates?
Yeah, absolutely. So utilities, REITs tend to be the higher dividend-paying areas of the market. They had a great run as interest rates were coming down, as the yield thirst hungry investors were searching for that extra basis point here and there. But if you look at sort of the REITs, the property cycle, particularly probably in Sydney, appears to have been coming closer to the end rather than the beginning. And as interest rates start to normalise, we've already seen this year the long end of the US Treasury curve has spiked, the yields have moved higher, and we've started to see the REITs particularly underperform, and that was the worst performing sector, I think, today. So I think you can expect to see that continue, because a lot of these companies that ran up as interest rates came down will probably be under pressure, not necessarily fall through the floor, but be under pressure in an environment where interest rates are going up globally.
What we're going to do now, we're going to have a look at the specific recommendations for sells versus buys in this portfolio. Now, I have a chart coming up here in just a moment, but the chart indicates for us, firstly, in consumer discretionary, some of the stocks that we're looking to sell. Now, Domino's Pizza and Star Group. Michael, let's talk about Domino's. It's in many people's portfolios. A lot of investors still unsure what to do about it after the dusting it's taken. What's your view on it?
Yeah, so look, I was happy to have a reduce as opposed to an outright sell, sort of bring back the position from about 6% to maybe half. The fact is Domino's has done an incredible job over the last couple of years. It dominates the domestic industry. It's managed to expand overseas very well as well. What will ultimately determine whether Domino's can take it to the next level is whether they can get the same sort of margins in the European business as they can in the domestic business. So that's the big unknown factor. They've been a good user of technology. There's no doubt they can try and replicate that overseas as well. But the fact is, unless they can replicate the margins on the European businesses where they've got it in the Australian business, it's going to be difficult to justify the price. There's some issues as well regarding their employees. So that's why going into the reporting season where this is all going to be put on the table, I think I'll bring my position back, particularly if I've had a pretty good run in it, which I think Jim has.
Star Group. I just want to talk about this one, Michael. You mentioned Star Group as a sell. It's done okay when we consider it against Crown. What's your view on it?
See, Star Group did very well in that they redeveloped the Sydney assets and they've had a big flow-on effect from that. But I do think the market's potentially underestimating the threat of the new casino coming into Barangaroo, and that's still some years off, but I think that licence, that exclusive licence that they've got expires in 2019. They've also going to have to do a lot of capex, particularly up in Brisbane. The old sort of Jupiter's there needs a nice new facelift, and with that comes risk. So they're going to have to stump up a lot of capital to conduct this capital expenditure, and if that doesn't go well, then obviously there could be cost blowouts, etc., and that will hinder the share price. So on one hand, that's one of the reasons. The second reason is the coming competition that Crown is going to bring on Barangaroo.
Okay. One thing I want to talk about, just for a quick moment, that we're all united on is selling Regis Healthcare. What's it for you, Michael?
Exactly the same reason. It's one of these businesses where its revenue tends to be capped by what the government will hand back to it. So for a business to have your revenue capped, but essentially your costs not fixed or variable, then it can put you in a bit of a pickle and start to compress your margins. So we saw only a sort of 12 months ago, maybe 18 months ago now, the government decided to alter a couple of things, a couple of the rebates that they were receiving, and it put all that entire space under significant pressure.
Michael, one of the stocks that did come up as a potential sell in your list was Blackmores. Now, it's had a pretty rough couple of days, off about 8 or 10%, I think it is at the moment. Why do you think Blackmores is no longer a hold in this portfolio?
It's more on sort of valuation grounds and the fact that it is a good performer in the portfolio, that it's taking up a fairly large weight. You have to recall that Blackmores was gone from $220 all the way down to sort of 90 6 months ago. Tony, you were onto this one, sort of going back to that point. I recall you sort of saying anything below $100 is a great buy, and it's turned out to be that way. It got back to $180 just very recently. I just think, again, one of these situations leading into the report, given that it has had some issues in recent years regarding the Daegu trade and the slowdown in that trade, that you might start to see some profit taking come into that entire space, A2 Milk, Bellamy's, etc. included. So it's more so for the fact that it has run very hard very quickly, and on valuation grounds it does look expensive. But if you really want to take a very long-term view, then you can probably just hold it. But if you're looking to be a bit more proactive around things, it's something that I think you can look at maybe at least taking some off the top.
The last one, very, very quickly, just running through this portfolio. We have a sell pretty much collectively on Commonwealth Bank, but in fact we've advocated a buy, incidentally and independently, on two fund managers, Magellan Financial and Janice Henderson. Now, I'm just interested, Michael, what's your view on fund managers? Why fund managers instead of a bank?
I think it shows as well that within certain sectors there are subsectors, and that's the thing to always consider. Banks at the moment, we sort of touched on, revenue growth is fairly constrained. Net interest margin growth is also fairly constrained. And the way I tend to look at sectors is, although the banks and financials, whatever it may be, takes up 35% of the index, the fact is I prefer to look at it from what's contributing to the index growth and the risk components. So something like IT, for instance, or something like the diversified financials are contributing a greater portion to index growth than, say, the banks, because the banks really aren't growing. And on the risk front, you look at sort of the banks, they've got the Royal Commission into them, you don't know what's going to be unearthed in that situation. So for an index weight of 35%, the amount of risk that's actually on the table for something like that is probably greater.
And forward. Let's have a quick look at where Jim's portfolio's landed then. Considering all the changes we've just made, we've run through 22 changes in no time at all. This is what it now looks like, Jim. Essentially, again, on the left, you're overweight certain sectors, which are the greens, and you're underweight certain sectors, which also means, therefore, if you continue to hold certain stocks, you are, in fact, underweight that particular sector. So there's a bit of jostling there to do in terms of actual sector weighting, and also, very importantly, the amount you own in each of the stocks. So there is going to be some trimming to some of Michael's points earlier, and also some outright sells. But it is a pretty well-adjusted portfolio. This one is still very growthy in terms of its prospects, although the dividend yield has actually dropped here to about 3.1%. That's not really what you're telling us you're after. The beta has in fact improved fairly significantly. It's gone from a bit of a slow and sleepy to something a little bit quicker, beta being relevant to the movement in the share market, and end of the day, something a little bit closer to what you asked for, Jim.
Convinced as well that over time the earnings growth of this portfolio will be significantly better, and then dividend growth will actually come in time, so you'll end up with a higher relative dividend yield than you would have otherwise.
Fantastic. Well, Jim, I hope that helps, just running through the portfolio.